Is AI now a stock market bubble? Many people are saying that, and many people are saying it's not. But who's right? AI is being hailed as the engine of the next economy. But now many financial heavyweights are warning it's a bubble in disguise. So this has happened before, folks, just to let you know, for those of you in your 20s. It happened back in 2001. A massive tech bubble popped and wiped out half of people's retirement savings. And it took years for that to recover. So if you were near retirement back then, you were screwed. In this video, we'll break down who's sounding the alarm, who thinks the high value is justified, what data says, and what this means for your portfolio. So this is not an investing channel, but this is a critical topic because, again, if this bubble pops and you're heavy into AI, you're going to get fried. If the bubble pops, and if it is a bubble. So this is not an investing channel, but this is a very important topic. So what is the evidence that's leading to talk of this bubble? JP Morgan's Michael Cymbalist has said AI-related stocks have accounted for 75% of S&P 500 returns and 80% of S&P 500 earnings growth since ChatGPT's launch in November 2022. So just coming up on 3 years, he's saying almost all the stock market increase and really almost all the earnings are AI driven. So what's to the contrary with what's happening? AI capital expenditure now contributes more to U.S. GDP than consumer spending in recent quarters. So to put that into context, how huge what I just said is, historically, consumer spending was roughly 80% of GDP, 80%. And now AI is bigger than that. This is a complete fundamental economic shift, which supports the argument that what's happening is real, not a bubble. So a guy named Neil Duda of Renaissance Macro said AI CapEx added more growth than all consumer spending during this 3-year period. And Harvard economist Jason Furman claims 92% of U.S. growth recently is linked to AI spending. By the way, that doesn't mean that this couldn't be a bubble, because some people say most of that spending is going into new data centers, which are going to get overbuilt, and then that's going to pop the bubble. We'll all find out together. More evidence, valuations, and concentration risk. The Magnificent Seven, which is Microsoft, NVIDIA, Apple, Google, Amazon, Meta, and Tesla, now dominate the stock market. This is because in the U.S., these companies are the drivers of AI. There's concerns about circular investments, with the AI companies buying chips and the chip companies investing in these AI firms in turn. This has resulted in sharp one-day stock moves. For example, AMD jumped nearly 40% after an AI deal news, seen by some as market froth. So that tech bubble wasn't the only bubble in our lifetimes, at least a lot of people's lifetimes. After that was the Great Recession, which was a massive real estate bubble. But these market bubbles go all the way back to the 1500s in Holland, the tulip bubble. This has happened over and over and over again for 500 years now. So this happens on a recurring basis. This is why this is so important. So who is saying, yes, this is a bubble? Let's talk about hedge funds. Elliott Management warns NVIDIA is way overhyped. Many AI uses are never going to be cost efficient, they say. That may be true. I don't know. Paul Dietrich of Wedbush says he thinks the AI boom has speculative excess and warns of a crash, especially with leveraged bets. So what that means is a leveraged bet is you borrow money to buy options that bet that the market or a company is going to keep going up. Very risky investment style. Many people have literally been completely wiped out doing leveraged bets. Veteran investor Bill Smead says he likens AI stock mania to dogs chasing cars. Momentum without fundamentals. That is a hilarious comparison. In addition to the hedge funds, there's also big institutions warning. The Bank of England and the International Monetary Fund have been raising alarms about overvaluation, tech stock stretch, and concentration risk. OpenAI's Sam Altman acknowledges that investors are overexcited about AI. I think that's putting it mildly at this point. Some analysts compare to dot-com era bubbles, fragile hype, overspending on infrastructure, and uncertain ROI. I think all of those comments are appropriate, by the way. It's just difficult to tell yet if this is going to be a bubble. So who's saying it's not a bubble or not yet a bubble? On Wall Street, major analysts, Bank of America and Goldman Sachs, say valuations are high but are supported by profit growth. Circular financing is limited. So let me say something about that. Okay, as a chief financial officer, which is my job, and I also do legal work at the companies that I work for, it's my job to understand the economy and understand it well. I consider myself an expert on the economy and economic trends after 20 years of doing CFO jobs. Historically, the market is best valued on PE, price to earnings ratio, and that historical multiple has been in the high teens on average. Right now, the multiple is about 40. On a historical basis, this market is insanely overvalued, and if it corrected to the norm, that would mean about a 65% drop in the market. That would do serious damage to people's stock portfolios. So this is a serious topic, and on historical basis, it seems way overblown right now. Again, some argue that AI's revenue is real, adoption is deep and broadening, and this isn't pure speculation. I think that's true. That's why it's difficult to say that this is a bubble. And the reality is AI is unprecedented. No one has ever seen a revolution like the AI revolution. Why? Because it's exponential. All of the previous revolutions were gradual. They took 100 years, 200 years, 300 years, 1,000 years to happen. We're talking the agricultural revolution, the industrial revolution, the internet, all this stuff. Well, the internet was like 50 years to fully mature, but this is 3 years. This is different. Proponents say AI is not just a fad, it's structural. Agreed. Productivity gains, automation, and new business models. Agreed. A complete change in our economy is what's happening. They argue that while we're still early, many AI applications are just beginning to bear fruit. This is true. People are just really beginning to use LLMs to anywhere near their capabilities. It's in its infancy still. Some suggest that this bubble narrative underestimates how much economic transformation is in flight. 100% agree. It's why I started this channel, because people have no clue what's about to happen. I've been warning everybody. It's iRobot. It's that movie. And it's massive job displacement. Massive. So let's do a compare and contrast. On valuations, they're very stretched. There's hyper concentration in their circularity, but some firms show strong earnings and demand. Let's compare economic reliance. AI capex is driving GDP. It's a worrisome dependency. This shows AI is core and not peripheral, which is true. Risk of crash, extreme leverage in the market, hype overbuild, infrastructure oversupply, versus structural adoption argues for sustained growth. So let's talk about the early stage argument. Many AI use cases are immature and the ROI is unclear still. However, breakthroughs in LLMs, automation, and robots show real value. This is really happening, folks. So there's arguments on both sides. Both sides acknowledge risk. The difference is how much margin for error they see. The bubble skeptics often argue for selective caution, not total denial. So what does this mean for investors? This is what matters. Diversify away from being overly concentrated in AI and megatech. Watch for signs of a tipping point, earnings misses, infrastructure oversupply, particularly data centers, slowing adoption of AI. Be cautious of retail leverage and speculative bets. Those often crack first. Yes, the more risky investment strategies fail first. Consider hedges in non-AI sectors, especially those that benefit from AI infrastructure. What are some of those? Consumer staples, stuff people need to live, groceries, certain parts of retail like clothing, etc. I am not giving investment advice. I'm just telling you what the experts are saying. I do not give investment advice. Make your own decision. So what's the conclusion here? This debate is heating up clearly. That's why I did this episode. AI is both an engine and risk. The hype is real, but the question is, has it outpaced fundamentals by PE wildly? We may be in a transitional phase that's part boom and part speculative stretch. I definitely think we're in a transitional phase of the global economy and how everything is done in the world is in transition now. That's why people are nervous. Change is hard. Psychologically, this is why I started the channel, to prepare you psychologically for what's coming. So what's the bottom line? Stay informed, be prudent, and be skeptical. Question. Don't follow the herd blindly. Question everything. But don't miss this critical transformation in the world economy. AI is hitting all the world equally. There is no favoritism here. It will hit everywhere. Do you think AI is the next Amazon or the next .com crash? What do you think? Drop your thoughts below. So thank you so much for watching. As I mentioned at the end of my last video, we've crossed a key threshold of 2,500 subscribers. Thanks very much to my core subscribers. We still need your support, so please like, subscribe, and share. Please support us on Patreon. The financial support is really critical to be able to bring you resources to help you prepare for the massive change that's here now. It's here now, folks. 1 million robots a year by 3 years from now. 1 million. Thanks so much. We'll see you next time. Take care.